Okay, then we're live.
Hello, everyone. Thank you so much for joining this session. Uh, it's been a while, and we wanted to talk to you about what's been happening in the markets since last time we connected. There have been a lot of developments that have happened. जैसे budget has happened. We have seen a few geopolitical events which have been concerning the markets. We've seen developments around FTA. So I'm going to talk about each and every aspect that has happened and that has impacted the markets, and then we are going to talk about what lies ahead and what needs to be done. So, if you look at the overall scenario, the FIIs have had a bit of a ride. They have withdrawn a lot of liquidity from the markets. उन्होंने आप देखेंगे तो over the last almost 1 year से ज़्यादा हो गया when they have withdrawn a lot of liquidity from the markets, from the Indian markets. Now, Feb has turned positive. In Feb, they have infused liquidity into the markets, and that has come after a lot of clarity that has come into the markets. The DIIs have been continuously supportive. The domestic institutions have been continuously investing. We have also seen the mutual fund liquidity continuing to the markets. That has been a very big positive. And जो भी selling FIIs की तरफ से हुई, that selling got bought in by the DIIs. I think that has been really supportive for the markets in these tough times, which had a lot of volatility. Definitely, if you look at the index was stable. Although, if you look at the broader markets broadly corrected in certain portfolios, corrected ranging from 10% to even 50%, and a lot of stocks had been correcting, and there had been challenges of investor liquidity in a lot of these stocks. But although the index was slightly stable, considering that a few stocks that were constituents of the index had large weightage on the index, had been stable, and hence the index was also stable. But if you look at the sentiments over the last few quarters, from euphoria kind of a sentiment in the till the last, or almost the last quarter of calendar year 24, uh, to these 1.5 years, have sentiments has significantly shifted to a negative. हमने बहुत सारी चीजें देखी. We, after Trump coming into power, we saw issues around tariffs, issues around geopolitics, issues around a lot of other areas, right? We've seen disruption around AI, and all those had created an impact on the markets, which were in a very good phase to turning them to negative, and wiping out capital for a lot of investors. Right. But if you look at now, the sentiment looks to improve. At least the kind of bloodbath that we have seen in the markets over the last few quarters, we have slightly improved from there. The bloodbath have stopped. We are seeing some sort of a volatility on the upside, and it looks like, even if you look at the statements coming in from a lot of large institutions of the US, be it JP Morgan and others, they are giving pretty aggressive targets for the indexes going forward. And when the indexes move forward, the FII capital has to come in, and that trickle down effect comes to the broader markets as well. And that is a positive. We believe that FY26 has to be good, considering that we have moved on from the phase of a bloodbath. We are consolidating, and we are seeing inflows, early trends of inflows coming into the markets. Uh, if you look at a lot of basic parameters, dollar index is 97. I think this is pretty stable. It's fallen. We've seen a lot of efforts around de-dollarization, then it moving to a different tangent, जहाँ पे Russia, then recently statements coming in from them that they want to they will go back to dollar for their trades. That is a big positive for the dollar, and there've been a lot of to and fro around dollar as well. There've been efforts around digital currencies to be linked to dollar, to be increased in potential. There've been efforts around reducing or taking out people from using any other currency than dollar. So there've been a lot of efforts from both sides, and we have seen a lot of to and fro. India has kept a geopolitical stance where they've been slightly neutral. We have not given very aggressive statements. We have not come up against anyone, and that has what has resulted in a very good positioning for India that we are in. I'm going to talk about that. If you look at the bond yields have been pretty stable. US it is 4.09, India is 6.73. I think it is pretty stable if you talk about the bond yields at this point in time. The crude is a bit tricky. This has been really stable and ensured that the overall economy stands on track. But if you look at crude at this point in time, there've been slight sort of a volatility. We have seen some rise in the crude prices over the recent days. That's because obviously because Iran is trying to ensure that crude instability causes panic and induces US Israel to not attack. We've seen such some kind of disruptions continuing on geopolitical front that is impacting the markets and bringing in some sort of nervousness. Like just day before, there were some news around US can attack Iran anytime, and that brought in nervousness to the markets. So see, this kind of a volatility will continue if you look at it from a broader lens. This kind of a geopolitical volatility will continue. A lot of it will be considered as a new normal, and you have to look at a lot of fundamentals inwards to be able to analyze these kind of situations. We are seeing a lot of liquidity. We have in these kind of volatile markets. You would see a lot of volatility, but you could make a lot of money as well in these markets, because these markets gives a lot of bouts of volatility, which could give you good returns, right? It is not that everything and anything and everything is going to fall. It is like certain pockets are going might fall, certain pockets might go up at any point in time. There will be time when everything goes down all of a sudden, then there'll be time that everything goes up all of a sudden, right? So in these pockets of volatility, if you invest with a discipline, if you look at if you don't go overboard in euphoric situations, if you invest in panic situations, there will be good considerable returns that you could make. I'm going to talk about that in the coming section. So what's happening geopolitically? We are seeing Iran issue evolving. We are seeing US and Israel trying to control them on the nuclears. We are seeing war around commodities. Commodities, I think, is a bigger source of war that is happening, because it is more around the oil. It is more around who controls the commodities, because obviously we are moving into an AI age, and some critical commodities. Like copper, like silver, like and as well as energy sources like oil are going to play a very vital role for differentiating and for establishing the leadership going forward for various countries. And that is the primary source of US trying to control Venezuela, of Russia trying to take parts of Ukraine, on a lot of other aspects, on Baluchistan, a lot of other aspects. We are seeing countries trying to control commodities, especially the developed countries, the leaders trying to, the top five economies trying to control the commodities, and showing aggression in trying to do that, considering that if they don't do it, they would not be able to generate access, because the prices or the rareness or the criticality of these commodities is increasing by the time we are seeing because of geopolitics, we are seeing a renewed interest in defense. We If you look at the budget this time as well, the budget uh, has increased the defense allocation from a 4.9 lakh crores to a 5.9 lakh crores. I think it's a pretty big kind of an allocation, and this thing is going to happen across the globe, considering that every country would try to protect itself. The kind of reliance some of the European nations or Japan or other countries used to have on, say, the US, that kind of a thing is going to shift, and we are going to see movements towards countries trying to protect itself with their own defense budgets, and that is the trend we are seeing for our defense companies as well. It's a uh, good foreseeable future that is foreseen for these companies as an investment. If you look at commodities, again, so commodities I've talked about. So Japan interest rates have caused some bit of a panic to the markets. This has been again another thing that has been of concern. We have seen a lot of we have seen the interest rates increasing in Japan, and that free sort of a money, and Japan being one of the largest investors in the US and the one of the largest contributors to the FII capital, has been taking a back seat, and the capital in times of volatility, in times of interest rate increase, in times of uncertainty, moves back out of risky assets, and that had caused some sort of a volatility in the US markets as well as nervousness across the global markets. You look at AI has been a big disruptor. Initially, people were not giving it that much weightage. A lot of our IT companies were not giving it that much weightage, and now all of a sudden it has become a very important piece of the entire business ecosystem. The IT sector has been bleeding. We've seen pretty significant fall in the IT sector because of across the globe, because of a lot of technologies, be it Anthropic, be it others. Considering that, I'm going to talk about IT sector going forward, right? So AI has been a big disruptor. The FII action has been a big a contributor to the volatility in the markets. You have seen a significant outflow, but Feb looks good at 13,000 crores kind of flows. DIIs have been pretty supportive, as I said. If you look at the results, we are closely tracking the results of the companies. We are closely working or talking to the management of each and every company that are there in the portfolio. So the companies have been pretty the outlook is stable. The outlook looks positive. There have been a lot of variance when it comes to sales, when it comes to EBITDA, when it comes to profit. So some companies have significantly increased profits or significantly increased revenues, but while some companies have significantly reduced them or even turned negative. There has been a pretty significant variance, but if you look at these kind of adjustments will happen when the geopolitics is evolving, when the AI is evolving, when the technologies or the supply chains are evolving. These kind of volatility are bound to happen. You have to look at stability. It's a stock pickers market. You have to look at stability in the markets while doing investments. If you look at the price to earnings multiples of the companies, we were looking at our portfolio companies. They've gone pretty comfortable over the last few quarters, and that gives us a lot of confidence that hey, things are not looking expensive, and whenever there is bout of FII liquidity coming in, whenever there's bout of markets performing well, these companies are going to outperform significantly. So that's what I'm talking about, that there'll be periods where there'll be significant growth in the markets, and these are one of those periods that are going to come over the next few months, where we are going to see significant bump up in the markets as we have come out of the significant drawdown kind of environment, and we are consolidating, and the FII capital have started to move in, and a lot of stability around the FTAs and other things have kicked in. So Indian markets have underperformed. You have seen versus the rest of the world. The some of the other economies in the world have significantly outperformed India when it comes to the benchmarks. We have, but if you look at how India is positioned at this point in time, it is a more stable kind of a capital that we believe should come in, considering where we are at this point in time. I'm going to talk about it. If you look at dollar has significantly appreciated versus the rupee. That has been deliberately also been allowed by the RBI to ensure that in times of volatility, the exports are in sync. We are seeing that the dollar has to a lot of investors consider that dollar appreciation wipes out their returns, and they have to adjusting for dollar returns, they have to get a positive return when they are investing in countries like India. But what we believe is that a lot of depreciation that were to happen in the rupee has already happened over the last few months. We've seen on an average we used to see 5-6% kind of a dollar appreciation. Currently, if you look at the last few months only, we have done way above that kind of a depreciation, and we believe that next few years, considering what has been happening, the kind of relationship now US wants to establish with India, considering that it's a tussle between primarily between the US and the China. They want India by their side in a positive manner. That's what is going to create inflows, good trade surpluses, potential, and inflows around FIIs, and that should improve the dollar, the rupee versus the dollar. So we have done a lot of depreciation of rupee, and we believe that this could also be an inducing factor for the FIIs to invest in India going forward. So if you look at FTAs, I think this is really interesting kind of a thing. Uh, India is one of the very rare earth or rare commodity or rare country that is there, which has FTAs with almost all all of who matters, right? Even today, Mr. Lula, who's from Brazil, the president has come here, and he's there are indications of partnership. But if you look at who matters, right? The UK, we have signed an FTA, and what is being said is that it should get implemented by June of 2026. And obviously, it is top five economy of the world. If you look at EU, I think this is pretty big, pretty huge. And what Mr. Piyush Goyal says is that it is going to get implemented by the end of 2026. And what is coming from the statements of of a lot of these countries is very, very positive. Even if you look at four countries, including the Switzerland, has signed in a binding investment term sheet of investing $100 billion into India over the next few years. It is binding, mind you. If you look at even the AI summit that has happened recently, a lot of companies have committed, ranging from 10 billion to 100 billion kind of capital to investing into the AI infrastructure in India. That kind of a capital coming in terms of FDI is looking really positive, and that also has to do with the kind of openness the government has shown, which is pretty not very seen in the past, where 21 years till 2047, there is a tax holiday for setting up the AI infrastructure or the data centers in India. That is pretty huge, and that is going to create a lot of employment opportunities, lot of proxy investment opportunities for companies who will be supplying or who will be participating in this infrastructure creation wave. So the FTAs, I think, like if I'm just going to give a simple anecdote, like if you look at the textile industry, India were at a disadvantage of at least 15 to 20% versus the rest of the world, because countries like Bangladesh, Pakistan had zero duties on exports to Europe, to UK, and when India gets a similar treatment, right? Despite the disadvantages, Indian textile companies were making profits, and when you do away with the disadvantages, where you are treated equally with countries like Bangladesh, countries like Pakistan in terms of textile, considering kind of scale infrastructure we have, we should see significant profit growth in a lot of our companies, and that is what we are also banking upon. The valuations have significantly corrected. We have the infrastructure. We have done a lot of inroads over the last few years with PLI investments, with infrastructure creation, and that disadvantage is now going, and looks very positive for the domestic companies to make profits going forward. India has a DNA of manufacturing, and that has to manufacturing and services, and that is gaining grounds. If you look at the manufacturing is infra, even with the AI disruption, it is not easy to replicate the manufacturing infra. You have to look at, say, if you want to set up a manufacturing infra, you have to spend 5 years to buy land, to create the shed, to get the connections, to make the processes, to get things live. It is not easy to set up that infrastructure. I think a lot of AI is going to make them more efficient, make them scalable. I think with the FTAs kicking in, a lot of these capacities will be booked by a lot of these foreign buyers. And now the growth for these companies will come by who can expand the infrastructure quickly, and take benefits of the kind of growth opportunities that are going to come in. And that's where we are banking on in terms of manufacturing, in terms of services, in terms of IT. This is slightly more tricky in terms of the AI kicking in. A lot of sectors are going to see more disruptions. A lot of that disruption scare has been already factored in the markets, with the kind of FIIs exiting a lot of capital from the IT sector, sitting on the sidelines for this sector, wanting to see how companies are pivoting. A lot of these companies are pivoting. We are seeing strategies coming up around AI. I think the talent pool across India is pretty significant, and the adaptability, although we are slightly late, the adaptability of AI is going to be immense for the Indian IT infrastructure. I think what additionally is going to happen is that a lot of these countries like European countries, they would want to diversify from a dependence on US to creating their own IT infrastructure, and that is going to give a lot of work to the Indian IT companies, as well as the infrastructure. IT infrastructure should be a good uptake going forward. So this sector, although it has bled a lot, I think the kind of capital, the kind of human capital and resources these companies have, looks very bullish if you invest in this for a foreseeable future. The budget has focused a lot on the infra. The budget came early Feb, focused a lot on the infra, and we were expecting a lot of freebies, which didn't come. The government has been very balancing in terms of trying to not increase the fiscal deficit, in terms of trying to create the infrastructure for the future to differentiate versus the rest of the countries, to try to capture on the FTA opportunities that are there. If you look at some misses, STT was a miss, and the markets did not like the non-clarity around the policy continuity, and that had impacted the markets. But if you look at the kind of infrastructure push that is there across the infrastructure space, it looks pretty good, because the GDP multiplier for infrastructure spending is humongous. You look at railway spending, you look at defense, you look at roads, you can look at textile parks, you look at wherever there have been significant opportunities that are getting created, and that spending. See, obviously, we have to look at the implementation of these policies. That becomes pretty critical. While the intent around this will generate a lot of interest from investors as well as from companies to participate in this kind of a growth, and we believe that that momentum should bring in good positive value creation for investors over the next coming years. So if you look at the domestic macros, they've been pretty stable, not concerning at this moment. If you look at GST collection, auto numbers, whatever numbers, although definitely there will be a lot of impact of what all disruptions we are seeing, but you have to look at it from right now. We are in a stable position. The markets have corrected, and from here, a lot of things should, like in terms of the outlook of a lot of companies, not looking bad. So we think that it is a good time to invest again. Uh, what has GP Green Portfolio been doing? To the portfolio, we've talked to almost every company that is there in the portfolio. We have tried to rejig the portfolio wherever we have seen fundamental weakness because of the changes that are happening. We've to be slightly more agile in these times. We're trying to look at what is happening on a continuous basis, talking to the management, and we feel fairly confident on the kind of portfolios we have evolved to at this point in time. Whenever the markets does well, we should do fairly well. If you look at the liquidity in the markets, the liquidity in the markets had, especially in the broader markets, had been worsening, and but over the last few months, we've seen the domestic investors continuing. We are also seeing FII coming back. So I think liquidity, once people are sitting on the sidelines, we're talking to a lot of investors sitting on the sidelines with liquidity to invest into the markets, but the sentiments were not supportive. Now that the sentiments should start improving, we should see liquidity further coming in and improving the markets. Uh, our few strategies, even in these worst markets, have done exceptionally well. Although, if you look at a 7 years period, 8 years period, the kind of growth Green Portfolio has done in terms of CAGR, we have been from a 8 year standpoint, so pretty consistent kind of a double digit, more than 23% kind of CAGR across our products, 23 to 32% kind of CAGR. But certain products have stood out, and I would want to highlight them in this conversation. Dividend yield product, which gives you dividend yielding stocks of say somewhere around 2 to 4% kind of average return, dividend yield of more than 3%. This portfolio has gone really lucrative, and this has been a consistent performance even despite the last 1 year of volatility. This has given a positive return, as well as over the last 7.5 years, it has given a CAGR of 32%. I think this is something to be highlighted, to be considered. If you look at what additional we are doing, we are bringing in ease of infrastructure of structures for you to invest. We have SEBI registered RA, where through which we participate in the small cases. We are also bringing in mutual fund small case baskets, going to be a pretty significant kind of move from our side. We are going to bring, we recently started an AIF to help you invest in pre-IPO opportunities alongside the listed opportunities. We are also establishing structures in Dubai in DIFC for catering NRI investors with easy clicks, with very less KYC implementation. You can now invest into Indian markets, be it listed or pre-IPO opportunities, through the structure ease that we are bringing in. Um, We've been working on equipping our team further. We've increased our presence in terms of our teams. We have created more processes. We are launching new products, and we are also implementing a lot of these AIs into the ecosystem, as we also want to leverage with the kind of opportunities that this AI is creating in terms of our own processes. We are also improving a lot with the AI. We have launched our own chatbot on our website as well to talk to you on a almost very instantaneous basis, right? So what's the strategy forward, right? Like, it's a very long monologue. I think what's the strategy forward? What should investors do going forward is what everybody is looking at. If you look at FY26 or this the rest of the year that is there, we are fairly confident on the stock markets going forward. We believe that considering everything, Indian market should do really well in this in the coming months, and it is a good time to allocate capital. We are seeing consolidation after the fall. The sentiment has been improving. The FII capital has to come in, considering the kind of interest rates have been falling, considering the kind of emerging market India underperforming dollar index versus the rupee, dollar versus the rupee, appreciating to a very significant level. We see that very good opportunities for FIIs to make money, and should see capital infusion into the Indian markets. Selectively, a lot of sectors should do well. We like energy, we like defense, we like infra, and there are many more. If you it's If you look at the broader markets, the kind of markets India opportunities to invest India presents, there are times when the volatility drawdowns the stocks by 30-40%, and there are times when in a year or two there are 400% kind of a jump on the stocks. We've seen that in a lot of instances. Even recently near COVID, we have seen such kind of instances. We have seen a significant correction, and now it's time to consolidate. And when the sentiments are slightly negative, these are the times when you make investments for a foreseeable future to make money. If you look at the policy, if the policy clarity continues, the DI inflows, I think, should continue with the SIP flows coming into the mutual funds. The emerging market allocation compulsion will induce the FIIs to invest into the Indian markets, and that has to do well for the Indian markets going forward. The NRI money flow is going to be stable and going to increase, is what we believe. The pipeline of the IPOs has been slightly sitting on the sidelines, and we see that a lot of IPOs have been approved, and they should come into listing spree once we see sentiments further improving, and that will bring in a lot of push to the markets. If you look at the sentiment damage that has happened around the AI impact, around the geopolitics, around the FIS sell-off, around the rupee fall, around all these sentiment damages are overdone now and are factored in into the prices. And we believe that this movement is a pretty significant one, where you see a lot of opportunities, where the lot of scare has gone away, while nothing, no point, you will see that everything looks very rosy. We are living in a very pivotal moment across the world. Definitely, there will be volatility continuing, but considering where we are right now as a economy, and where we are right now as markets, there are huge opportunities to make money. You will have to capture the kind of short-term upticks that are there. So I think this is a good time to make your investments. We are happy to talk to you. I think thank you so much for hearing this. Looking forward to catching up in another session. Thank you.
हेलो। हाँ जी, दिव्या।
जी।